Hello everybody, welcome to the core content lecture. This one will be focusing on identifying low probability scenarios. So getting started with premium and discount correlation. Now I've talked a little bit about this in the past, but we'll go a little bit more in depth. So when utilizing concepts for a reversal, the assets you compare must be synchronized to premium and discount. So it is important to keep in mind you are using this when you are seeking a reversal. So let's say we're comparing two assets and we have our premium and discount outlined. So this might look a little bit different or a little bit weird because we're using in this diagram from this high to this low, when typically you would use something like this high to this low or this high to this low. So whenever you are looking at a sequential SMT or an SMT in specific, the asset that breaches the high or creates the stop run will go into what I like to call deep premium for a bearish example. And in a bullish example, it would just be deep discount. So we're going to focus on the bearish example, but everything is vice versa for if it were bullish. So as we can see, we have a price leg before the asset that we're looking at on the left creates the stop run trading above this high. So why are we choosing from this high to this low? Well, if we look at the asset that would create the failure swing, this would be the same high to low that the failure swing asset has to respect going into premium, creating that sequential SMT for price to draw lower. So if you see an SMT that is not correlated, meaning let's say the asset on the right we're trading lower and it didn't trade into premium, and the asset on the left ran above the high while the asset on the right was still trading in discount, this is a low probability SMT. And to add on top of that, if a TPD were to also form, you would want it to be retrospect to premium and discount on all of the assets, meaning a TPD should form in premium on all of the assets if you're bearish, and a TPD should form in discount on all of the assets if you are bullish. So in a low probability scenario, the asset on the right would have created the TPD in discount, while the asset on the left would have been trading into deep premium. And if you go back and look at the Dow on Tuesday, May 13th, 2025, you will see that the assets were not in sync to premium and discount, and that's why that SMT ended up failing, which is what we wanted to see. This was a contributing factor as to why I wanted to see that SMT fail and how I knew that the Dow was quote unquote out of sync. So in summary, the asset that creates the stop run trading above a high, use that previous price leg before the asset trades above the high, and then simultaneously on the asset you're expecting a failure swing, you take that same high to low, print it over there, and then this same asset should respect premium and discount, following in tune with the asset that creates the stop run. And if it doesn't do that, then that immediately is low probability, and you don't want to trust it. But now looking at post weekly range expansion. So after a higher time frame weekly objective has been breached, more times than not a period of consolidation will occur. So this consolidation generally lasts 1 to 2 days, but sometimes can last for the rest of the week, depending on the week. The reasoning behind this is a price can stabilize and generate liquidity to allow another price run to begin. So this is what I coin stabilization in price. As you know, generally after a higher time frame draw on liquidity is reached for us, I say we need to wait for stabilization before looking for something to do again. This is exactly what I am referring to. And knowing of how long that consolidation will last depends on the week. So if the week is pretty lackluster in news, then you can expect it to last for the rest of the week. But if that week is jam-packed with news, or let's say there's, non-farm payroll later in the week, then you can expect a bigger expansion later on in the week, and for that stabilization to not act as long. So as we can see on the chart, we wanted to see this weekly candle right here draw into this weekly time frame fair value gap, and as we can see, as soon as price reached that weekly time frame fair value gap, the first half of the week ended up being very expansive and ran to it very fast. But as soon as we reached that weekly objective or that higher time frame draw, price just stayed majority in a period of consolidation for the rest of the week. And now, when to trust the economic calendar. So just because a day has news doesn't mean it will be high probability. Just because a day doesn't have news doesn't mean it will be low probability. So you're probably wondering, okay, Jacob, you've been hiding this from me all this time. What are you talking about? Well, let me show you. So let's say we have a higher time frame draw on liquidity, and price has created a Kraken correlation with Monday and Tuesday being either a true reversal or a timed true reversal. And you've identified the higher time frame draw on liquidity in this bullish example right here, and Tuesday being the day that creates the time true reversal or the true reversal trades higher. If Tuesday trades and closes and we're still a little ways away from that higher time frame draw on liquidity, then that following day, which would be Wednesday, even if it doesn't have news, generally will serve an amazing continuation day, even though there's no news. So you're looking at Tuesday's gaps, and you're looking for the New York morning session to trade into those gaps created on Tuesday, which would be the same day as the true reversal. And you're looking for a setup there that will continue the expansion. So non-news days, whenever you're expecting them to serve as continuation days after a true reversal has occurred and there's plenty of room left to try to get to that higher time frame draw on liquidity, those are the best days to trade that do not have news. Now, on the contrary, let's say that same exact thing formed and Monday and Tuesday created a true reversal. Well, Tuesday creating a true reversal, creating a Kraken correlation on Monday's low. Let's say it was a sequential SMT, or it could have been a TPD, just something telling you a time true reversal or a true reversal has taken place on Tuesday. And Tuesday had news. That's what these little red bubbles mean. And Tuesday had news. So let's say Tuesday expands, but Tuesday expands very rapidly towards that higher time frame draw on liquidity, and price is pretty much near or at that higher time frame draw on liquidity. Then that next day being Wednesday, if we don't have news, then you wouldn't expect price to continue expanding. You would expect it to maybe reach a little bit higher and trade into that higher time frame draw on liquidity, but more times than not, you can expect lackluster price action. And this follows hand in hand with the previous slide of once you have a weekly objective or a higher time frame draw on liquidity hit, that's when you can see stabilization. So in short, in summary, if the day following a day with news or the day that creates a time true reversal, if there's still plenty of room left to try to trade into that higher time frame draw, then generally that day that doesn't have news will serve as a great continuation and still continue the expansion. While on the contrary, if the day that creates the true reversal that has news and that same day trades rapidly towards that higher time frame draw and it's a large range day, then you can expect the day following to not be as good and to see those clear-cut, textbook low probability days without news. So hopefully I'll find this one insightful. I'll speak with you all again soon. Good luck and good trading.